fact that the market's being driven by the wealthier people, the fact that the rental market is supporting it, the fact that interest rates won't go up as nearly as much as people are saying they will, the fact we're not building enough houses, all those points mean that house prices are not going to tank. Eighth of April 2022, Market Wrap number 95, Stuart Williamson here at the helm. Why are we doing this? To give interested investors in the UK residential property market some help in making buying decisions. Where to buy, whether to buy, how to buy. And that's what we do at APW. We are buyers agents for investors or expatriates. Potentially both. We take a shopping list from them that helps them achieve their goals with property. Now this week, I'm not going to have too many nautical comments. Okay, I've said I'm at the helm. This week we're conducting a review of the UK market to check its health, see whether it's plain sailing, and assess if the effect of the Ukrainian conflict is going to cause a house price crash. I'm not going to denigrate that in any way. It is a terrible thing that's going on there, but we need to assess what we're doing financially. Current residential market situation, well, we've all heard about the 12% increase in price of petrol on Monday in the UK, but despite that, annual house price growth is still at 14%, 14.3% in March, according to Nationwide. The growth is following 3 successive interest rate hikes, plus this huge inflation that's going on in the UK. They're talking about it reaching 10% by October. Growth has been strong across all regions, so London's starting to pick up now. Strongest in Wales, where it's up by 15.3%, weakest in London, where it's up by 7.4%, and this is basically down to persistent supply-demand imbalance, which we're going to get into in more detail. It's not a general imbalance, but we'll get into it in more detail. Blaenau Gwent and Merthyr Tydfil were 24 and 22% up, respectively, and the growth was weakest in Newham in London, down 4.3%. So, supply imbalance, what does it mean? Zoopla reports that the total amount of stock advertised for sale in the UK in February was 42% below the 5-year average, despite a gradual improvement in levels of new stock coming to the market. At the same time, data from the Bank of England shows on a seasonally adjusted basis the number of mortgage approvals in February were 8% above normal pre-pandemic levels, although 18% less than a year ago and 4% less in January. Okay, so that is all very positive. Data from 20CI, which also captures cash buyers, a bit of a bigger picture, suggests that the total number of agreed sales in the month remained around 26% above normal pre-pandemic levels in March, whilst new instructions coming to the market were 5% below that benchmark. So more activity, more interest, less supply. More demand, less supply. The same 20CI data suggests that activity remains strongest at the top end of the market, and this is where the point I think is we're going to see today, because it's more insulated against these financial pressures. Agreed sales over £1 million remain more than double pre-pandemic levels. Okay, I know there's a lot more houses now that are more than £1 million, but there's still a lot. Savills indices suggest the rates of price growth in the prime market are which is above £1 million, are beginning to narrow between London and the regional markets as people gradually return to the office and international demand starts to pick up in central London. In the first 3 months of the year, prices in prime central London increased by 1.1%, which is the highest figure for 8 years. That's how badly London's been doing. Whilst those in outer prime London rose by 1.7% compared to gains of 2% regionally. Okay, so frankly, it sounds pretty healthy at the medium to the top end of the market. So let's just cover the rental market now. Is this supporting the overall residential market? Now, according to Zoopla, who are very good at this sort of thing, the overall view is rental demand has risen strongly amid increased activity in city centres, but supply is still constrained, leading to the fastest growth in rents in Q4 of last year than any time over the preceding 13 years. That's according to Grianne Gilmore, who's the head of research at Zoopla. I hope that's how you pronounce your name. And then an executive overall summary is as follows. UK annual rental growth for new lets rose by 8.3% in Q4 2021. And it's the same thing. Chronic shortages of supply, demand is good. Now, does this mean that rents are getting too expensive as per last week's comments in the US market, in the market wrap? No. Rent as a proportion of a single earner's income is still 37% and is still broadly in line with the 10-year average, which is 36%. So there's no crisis of affordability. London rents are up 10.3% on the year, but large falls in 2021 actually mean that average rents are only up by £18 a month since March 2020. UK rental demand is up by 76% in January compared to the same periods in 2018 to 2021. So it's a huge amount of rental demand. Community rental growth is 12% over the last 5 years, 12% up over the last 5 years, slightly under the rise in average earnings over the same period. So we've still got that same matching situation. Now, that's not going to happen, I don't think, going forward with income levels actually falling. As the demand peak falls back in the coming months, less pressure on rental supply will create more competition in the market and put the brakes on the scale of rental growth. So that means rental growth won't be going up as much, which is just as well because incomes won't be going up as much. Let's just focus on one point here about the rental growth in the cities. If you have a look at this chart, what we need to really think about is what are the underlying indicators in these areas. What are the things that on the surface look normal but actually are things to be concerned about? So is the conflict going to cause a correction? Is the UK housing market set to hit the buffers? Now, there are three real points here. Cost of living increases, interest rates, and supply and demand. Now, I'll try to put these together as simply as possible. Hopefully I'll get it across correctly. Although the Bank of England base rate went up by 0.75% over the last month, mortgage lending rates are still at all-time lows. Okay, in the longer term, they will rise further. Energy and logistics inflation is increasing increasing the cost of living for everyone. As I said, 12 pence on a litre of petrol. Mortgage rates will go higher in the longer term, and this will limit price growth. So the level of activity in the market may well be reduced, but it's the first-time buyers who are going to be most affected in their attempts to buy property, as they're contending with a rapid increase in rental prices, which is true, which will cut the amount of money they can save for a deposit. At the same time, it's harder and harder to get small loans in the UK. Try borrowing less than £100,000 and you'll find out. Also, it will take time for interest rates and cost of living inflation to bite into the housing market, because it is driven by the more affluent households, as we've already seen. £1 million plus houses are going up like no tomorrow, because they can cope with cost rises better. Rental value, though, that growth is strong at 10.2% in February, and with a significant gulf between demand and supply, that will continue to lift up the market and keep the housing market going. So the ongoing demand for rental properties, because people want to get out into the country and rent, they want to get back into the cities and rent, and we've had a shortfall in building for so long. But let's cover interest rate rises. With these rising, won't that cause a housing fall? No, the effect of the Ukrainian conflict actually means that the Bank of England, the MPC, Monetary Policy Committee, cannot raise interest rates as high as it would like to have done previously, because the global recession is on the horizon and its effect in the UK. Therefore, we need to keep the UK economy rolling, stop it stalling in case the global one does. And this, interestingly enough, has already been reported by Bloomberg, as it's been reflected in the betting in the markets that interest rates will peak at end 2023 and start falling again. So that's already been betted on in the markets. So that's the high point in a year's time probably of interest rates. So you look at all those things together, The fact that the market's being driven by the wealthier people, the fact that the rental market is supporting it, the fact that interest rates won't go up as nearly as much as people are saying they will, the fact we're not building enough houses, all those points mean that house prices are not going to tank. And let us hope that the Ukrainian situation is resolved as quickly as possible with no more suffering. But the point is the UK market is not going to be affected by whatever comes out of that. It's really a soft landing, as the OBR said last week, and then back up again in 2027. I hope you found that useful. Please do subscribe, do press like. Even if you didn't like it, press like anyway, just for our sakes. Thank you very much for watching, and I'll be at the helm again next week, hopefully steering a good course through the property market. Thank you. Bye-bye.